Friends, welcome back to the Business Leadership Series. My name is Tim Fulton. I am your facilitator today for the program. On behalf of USPAACC and TD Bank, our sponsor, I want to welcome everyone back. I think this is the seventh or eighth workshop in the series. I don't know who's responsible for the background music. I was really enjoying that music. Maybe I've just missed it in the past, but I was really enjoying that music. So today, again, our topic is accessing capital for small businesses. Like many of our topics, this is one that we could spend an enormous amount of time talking about. But today, we've just got a little less than an hour, so try to give you the best of what you need to know about accessing capital for your business. So I want to start off with the following. I just want you, just for fun, I want you to assume for a second that you have got unlimited capital available to your business, i.e., I could write you a check for a couple $100,000, $1 million. Just assume for a moment that you have access to unlimited capital. And I'm curious, what would you do with that money within your business? It's got to be within your business, nothing for personal uses, but within your business. If you had unlimited capital, how and where would you use that money? So just use the chat function on the bottom of your screen. And just how would you use that money? You'd hire somebody, you'd purchase a piece of equipment, you'd buy a piece of real estate. If you had unlimited capital, what would you do with that money? Let's see what comes up here. Uh, no one yet. Unlimited capital. What would you do with that money? Where would you spend that money if you had all the money you needed for your business? Again, use the chat function on the bottom of your screen. Just curious how you would spend. What would you do with that money? Would you hire somebody? Would you buy something? Would you expand? Would you add a new product? Unlimited capital. I don't see anything yet, but maybe you're contemplating that question. Usually when I ask that question, I get answers like, well, I would hire a salesperson, or I see, buy competition. I like that. Buy a warehouse, piece of real estate. I would buy a piece of equipment. I would introduce a new product. Those are the types of things I usually hear when I ask that question. If you had unlimited capital, how would you spend it? Well, why would I start off today's session with that question? Well, I start with that question because the reality is, in today's world, as a business owner, there is unlimited capital available to your business. There is unlimited capital available to your business. There's more capital available today for small businesses than there's ever been before. Between banks and investors, there's more capital available today to small businesses than there ever has been in the history of business. I think sometimes we overlook that. But there's a caveat. There is a caveat to that. That while there is unlimited capital available to each and every business today, the flip side is never in the history of business has it been more difficult to acquire that capital. So on one hand, there's just lots of money looking for investment from banks and investors. And on the other hand, it's become increasingly difficult for small businesses like yours, like mine, to access that capital, whether it's your bank that's over time has requirements have gotten tougher and tougher to get approved. The approval rate now is in the low 30% average for small businesses getting approved for a bank loan. And for investors, that percentage is even smaller. So lots of capital available, very hard to acquire that capital. And those are the kind of the dynamics that we're facing in today's world when you think about accessing capital. So Danny, if we could put up that first page of the handout, I hope each of you have a copy of the handout. It's the same handout we've been using for the previous programs, and we'll start there. So this came from an article that was in Inc. magazine a number of years ago, and you've got this in your handout. It says, where should you look for money? And it's 2 pages of questions. I don't want you to do this now, but when we finish today, as you begin thinking about where can I access capital for my business, by taking this kind of short questionnaire, and based on your answers, you'll add up the points and it'll give you just kind of a ballpark idea of where you might be able to access capital within your business. So when I think about accessing capital, I think at the highest level, as whether you're the owner of your business, you're the principal, you're the general manager, when you're thinking about accessing capital, I think there are three important components. Number one, you want to get the right amount of money. You want to make sure you're using the money in the right area of your business. And you want to make sure you're getting it at the right time, that the timing is of equal importance. So getting the right amount of money, applying it in the right place within your business, and doing it at the right time. So at the highest level, I think those are the three things that we need to be most interested in as we're thinking about accessing capital for our business. Danny, let's turn to the next page in the handout there. One more page. There we go. So when we're thinking about accessing capital, it's important to understand that there are the type of capital that you can access for your business, for your small business, in some way depends on where your business is in terms of growth stages. And you see this page in your handout, you'll see it shows everything from being pre-seed, which means you haven't actually started your business yet, to starting your business, the startup phase, and then what we call the growth stage. And so where your business is on this kind of growth curve will determine to a large degree where you will find money for your business. And if you start all the way to the left there, you see for a brand new business, you don't have a lot of options in terms of acquiring capital. It's mostly your money, friendly family, friends, and relatives. But as your company grows, you will find additional options for capital, whether it's your bank, whether it's an investor, an angel investor, different types of lending institutions, online, offline. But just know as you grow your business, your options for capital will increase kind of geometrically based on the type of growth that you're having. So when we talk about accessing capital, there are really two buckets of money available to any business, two sources of capital, and that is debt and equity. Debt is money that you're borrowing either from individuals or more likely from the bank. Traditional bank loans are interest-based. You borrow money, you pay interest on that. There's also what are called revenue-based loans that are becoming a little bit more popular, that you're able to borrow money based on the amount of revenue that you're producing. Another type of borrowing is more short-term lending, is what's called factoring, where you're borrowing money typically to finance maybe your receivables or your inventory. Also, another type of loan is a line of credit that banks offer. That's a very short-term loan, typically due back to the bank within 1 year or less. And then, so that's the debt, one form of capital. On the other side, we have what's called equity financing. Equity financing is ownership, where you're selling ownership in your business, whether it's, again, to family, friends, relatives. It could be to an angel investor, particularly if you're a younger company. It could be a private equity firm, could be a venture capital firm. Those would all be examples of equity capital. And then what we've seen in the last decade, a lot of growth in is online capital. Again, they could be either debt or equity, where you're going online and looking for capital, shopping for money. But let's go back just in general, debt versus equity, and how does a business owner like yourself, how do we decide between those two? Well, you may recall, I think it was either last session or one before, we looked at some of the financial ratios. And one of those ratios speaks directly to this idea of capital, and that is what's called your debt to equity ratio. How much debt do you have on your balance sheet versus how much equity? And you may recall the average small business, that ratio is 1. For every dollar of equity, there's a dollar of debt. So, and that's not unusual. For most small, mid-sized companies, there's usually pretty close to an equal amount of debt, financing, and equity. But what goes into that decision? How, as a business owner, how would you decide how much debt do I want to have, how much money do I want to borrow versus how much maybe ownership am I willing to give up, how much equity? And I want to suggest there are several factors, two particular factors that come into play. One is the cost of the capital. How much is this money going to cost? If I'm going to say, let's say I need $100,000 for my business, and I have a choice of either borrowing money or looking for an investment of that $100,000, the first thing I would look at is, well, how much is that money going to cost from either source? Well, in today's world, if I go to the bank, probably the average interest rate on a bank loan today is maybe between 7 and 8%. For a traditional term loan, between 7 and 8%. So the cost of that money would be, let's say, 7%. What about investment? Well, in today's world, most investors for a small business are looking for prior return on their money of at least 15%, maybe as much as 20 or 25%. So let's call it 20%. Cost of equity financing, 20%. So I can either borrow money at 7% or take an equity financing, and that's going to cost me 20%. So clearly, the bank money is less expensive. And that's why some small businesses choose to borrow money versus take equity investment. But there's a second factor that's equally important, and that is the risk associated with each form of capital. Because whether it's debt or equity, as to the business and to the business owner, there's an element of risk. To borrowing money, the risk is when I borrow money, I sign a loan document. It's a legal document where I promise to pay that loan back, whether business is good or bad, whether I'm making sales or not. When I sign that loan document, I am guaranteeing that I'm going to pay that money back along with the interest charges. It's a legal document. I have to pay that money back. Let's compare that to equity. If someone decides to invest money into my business, say that $100,000, they now become an owner of the business, a partial owner of the business. They have equity in the business, and they're expecting a return, whether it's annual distributions or maybe when I sell my business, they're expecting to get their money back and some. But the difference is there's no legal requirement for me as a business to pay anything to my investors unless something has been arranged ahead of time. There's no legal requirement that I pay that money back. So in terms of risk, while the bank loan is less expensive, it also carries more risk for the business owner. So there's an inverse relationship between the cost of the money, debt versus equity, and the risk associated with that money. Inverse relationship between the two. So as a business owner, I have to weigh those two factors and then decide how much money I want to borrow versus how much money do I want to take in terms of equity. Several other factors come into play in making this decision. One is going to be what am I going to do with the money? If the money is to fund maybe the losses in the business, maybe my business is not profitable yet, and I want to fund those losses, very unlikely that a bank is going to lend me money to finance my losses. More than likely, there I'd have to get some type of equity financing. If I'm using the money to buy a piece of equipment, okay, now more likely a bank would be interested because that piece of equipment would serve as collateral for that loan. I would be able to pledge that piece of equipment as collateral for that loan. So for whatever reason, I fail to pay back that loan, at least the bank can take that piece of equipment as collateral. So the use of funds also will determine, in many cases, the type of financing that I'm going to use. Another factor is market conditions. You know, are we in a good economy, bad economy? Interest rates are high, interest rates are low. Market conditions, to some degree, might affect which form of capital I'm going to access. How quickly my business is growing will also impact. Uh, banks like to avoid two things. They like to avoid businesses that aren't growing, and they like to avoid businesses that are growing too fast. So just know if your business is not growing or it's growing too fast, you're going to be less attractive to a bank. But to the investors, if your business is growing rapidly, that could be very attractive to a investor, whether it's someone you know or a more practical investor. So the growth of your business is going to impact the size of your company is going to impact whether you can borrow money or take investment, how long you've been in business. Most banks today will not lend money to a business that's been in business for less than 3 years. Most banks want to see at least 3 years of history of your business before they can consider a bank loan. Also, know another factor is what industry you're in. Some industries are more attractive to banks, typically more traditional industries, brick and mortar type businesses, versus maybe a technology company or a virtual company that may not be as attractive to a bank as it might be to an investor. So just know different industries tend to be more attractive to banks. Some tend to be more attractive to investors. So a number of different factors that you need to know about when you go shopping for money, when you go looking for a bank loan. Okay. Danny, let's go to the next page in the handout. So let's go back to borrowing money. When bankers go to banking school, we'll call it, almost always they are taught what are called the 5 C's of credit. The 5 factors that matter most to a bank and a banker in making a lending decision. And what I'll do is I'll walk through these 5 C's of lending, and you can fill these in your workbook as we go through these. And also, as we go through these, think about how your business would stand up in each of these 5 areas. The first C of lending is character. Character. And in banking terms, character speaks to what is your history? What is your credit history? What is your history of borrowing money and paying it back? Because banks like to see a history of a potential borrower of borrowing money, paying it back, borrowing money, paying it back, both in business terms, but more than likely, they're going to look at your personal credit history as well. Borrowing money, paying it back. This speaks to your character as a borrower. Do you have a history of not only borrowing money but paying the money back? That's character. The second C, the second thing the banks are going to look at is capacity. And in this situation, capacity speaks as a business. What is your ability to pay the money back? If you're going to borrow again, if you're going to borrow $100,000, the bank is going to look at, do you have the capacity? Do you have the ability to pay this money back over 2 years, 3 years, 5 years? And they're going to look at, in making that decision, they're going to look at, one, your financial position. Do you have money in the bank? Are you liquid? Remember a couple of weeks ago, we talked about the importance of liquidity in your business, having access to cash. They're also going to look at, again, at what you're going to be using the money for. And they're hoping that whatever the use of funds is, at least in part contributes to your ability to pay the money back. i.e., if you're going to use the money to buy a piece of equipment, which is going to allow you to generate more sales, that would be very attractive to a bank because they see that loan is going to help create more sales, which hopefully will create more cash, which will allow you to pay the money back in the appropriate amount of time. So they're going to look at your company's capacity to pay this loan back in the amount of time that's required. That's the second C, capacity. The third C is capital. And in this situation, capital speaks to how much money are you willing to contribute towards this use of funds. So going back to the piece of equipment, I want to buy a piece of equipment for $100,000. The bank is going to ask me when I go try to qualify for a bank, they're going to say, Tim, of that $100,000, how much are you willing to contribute? And what they'd like to see is they'd like me to be able to put in 5,000, 10,000, $15,000 of my own money to help purchase that piece of equipment. That's in a way, that's a sign of good faith that this piece of equipment is so important to my business. I'm willing to put up some of the purchase with my own money. And I'm not asking the bank to put up the entire, in this case, $100,000. So that they're looking for my capital. How much am I willing to contribute towards this use of funds? Third C stands for capital. The fourth C stands for collateral. Most banks are going to require, if you're applying for a term loan, long-term loan, they're going to look for some type of collateral. Collateral is an asset that you're pledging to the bank that if whatever case you fail to pay on this loan, that the collateral is an asset that they'll be able to take from you to help cover some, if not all, of the amount of the bank loan. Now, some loans are what are referred to as self-collateralized. Again, the example would be if I'm buying a piece of equipment, that piece of equipment is going to act as a piece of collateral. Now, the bank may require additional collateral, but at least as a starter, that piece of equipment would be used as collateral for that loan. So in a way, that loan is self-collateralized if the funds are being used to buy that piece of equipment. Same thing if I'm buying a piece of real estate, that piece of real estate is now going to become collateral for the bank in case I fail to perform on this loan. If I don't have assets, they may require that I put up a personal asset, that I put up my home as collateral, or I may have to purchase CDs at the bank to act as collateral for this loan. But don't be surprised when the bank asks you for collateral for your loan. The fourth C is collateral. And finally, the fifth C out of the five stands for conditions. What are the conditions around this particular loan that make it attractive to the banker? Examples would be a good economy. Okay, good economy. We hope that your business is going to benefit from this good economy, and so that's going to make the loan attractive. Other conditions would be how long you've been in business and what type of business that you're in, and who are your customers. Are you doing business with Coca-Cola and Home Depot? If you're here in Atlanta, maybe you're doing business with the state of Georgia or with the federal government. They're going to look at who your customers are. They're going to look at your financials and make sure your financials can support this loan. What are the conditions both internal to your business and outside of your business? Are you in an industry that's expected to grow? Is there a certain technology that maybe is affecting your business in either a positive or a negative way? So they're going to look just in terms of what market conditions make this a good loan. So these are the 5 C's of lending. Bankers are taught all 5 of these in banking school. They carry these with them to whatever bank they work at. Just know that when you go to a bank to borrow money, these are the 5 factors that are going to matter most to a bank. So what I suggest to my clients is do your homework before you go to the bank. Take a look at each of these 5 factors and just ask yourself, okay, how will I be evaluated in terms of character? How will I be evaluated by the bank in terms of capacity, capital, collateral, conditions? Do your homework before you go to the bank. Okay? All right, Danny, let's go to the next page. So very popular with small businesses, if you go to the bank to borrow money, are SBA loans. Some of you may be familiar with SBA loans. Some of you may actually have gotten SBA loans before. An SBA loan is not a loan that's actually coming from the SBA. It's a loan that's coming from a bank that is being guaranteed for the bank by the SBA. So it provides an additional level of protection, so to speak, for the bank. In case you fail on the loan, they can then turn to the SBA to get this loan paid off. So I suggest to my clients that when they're shopping, when they're looking at a bank loan, look for banks that do SBA lending. Not all banks, not all commercial banks do SBA lending, and some banks do more than others. If you're looking for an SBA loan, what you're looking for is a business that has qualified as an SBA lender, meaning they've done enough SBA loans that they're now considered a preferred SBA lender. That's what I suggest. Look for a preferred SBA lender. And then what you have on this page are just a number of questions to ask before choosing that SBA lender. And I've just a couple of these. You want to ask, do you participate in the SBA loan program? There are several different SBA loan programs. And the benefit of the SBA loans typically is because they're guaranteed by the government, they're a little easier to qualify for. In some cases, they don't require as much of your own money in terms of a down payment. And in some cases, maybe not as much collateral. And sometimes the terms of the loan are longer than what you would expect in a traditional. Instead of maybe a 5-year, it's a 10-year loan. So the terms are maybe a little longer on SBA loans. So here's some questions. You ask them, do you participate in the SBA loan program? What's the loan process? That's a fair question to ask the banker. How long does it take to get a loan, whether it's an SBA loan or not? How long can I expect? Because typically the loan that your person that you're talking to at the bank is, they're going to take all of your information and they're going to do a write-up, so to speak, for the bank. And then that write-up goes to a department that will approve or not approve of your loan, whether it's a local department or maybe in the bank headquarters. That ask them about the loan process. Ask the banker what their level of SBA authorization is. Every banker has a certain level of authorization in terms of loans that they can approve, or it's got to go to a loan committee or a bank committee. What's been your volume, SBA loan volume? I know in our local newspaper here in Atlanta, I'm here in Atlanta, or I think it's our business newspaper every week, it shows who the top SBA lenders are in this market. And that's maybe something you may want to find out. Who's the SBA specialist? What's your legal lending limit? What kinds of businesses do you lend to? Some banks will specialize in certain areas, like they might specialize in real estate, or they might specialize in import export or international or retail, construction. So it's a good thing to ask the banker are there certain areas that this bank specializes in? Do you need my credit score? That's an easy one. They will always need your credit score, always. And so you certainly want to take a look at that before you borrow money. That goes back to that idea of character as a borrower. What's your collateral policy? And can you introduce me to venture capitalists and mezzanine lenders? So these are just a couple questions to ask before and when you go to the bank. All right, Danny, let's go to the next page now. So I'm going to finish up here this afternoon with a list of what I call financial do's and don'ts. Just these are things that you want to be mindful of, whether you are borrowing money or going to investors. And I want to make a quick point before we go on, because I made mention that in the last decade, there's been a big increase in the number of both banks and investors online. And I've had some clients who have gotten either a bank loan online or investment. And two things I want to tell you about that is, one, those types of loans tend to be far more expensive than traditional bank loans, online lending. Because they're not traditional banks, they can charge much higher interest rates. I saw not too long ago the average interest rate on an online loan was over 90% annually. Remember, traditional banks, interest rates 7%, 8%. Online lending, average interest rate over 90%. So if you're looking to borrow online, it may be quick, right? They'll tell you we can approve your loan in 24 hours. Just know more than likely you're going to be spending a lot more money in interest on that loan. So be very careful when you're going to, we'll call non-traditional lenders or investors. Okay, let's go back to the 10 financial do's and don'ts. We'll start with the do's. Number one, you can jot these down as we go through them. Number one is you want to ride on, I call it ride on more than one horse. Meaning, it used to be that if I was in business, I would have one bank. I didn't have a need to have multiple banks. Well, that has changed, particularly since the recession of 2008, when we had so many banks fail. The number of banks today is about half of what it was in 2008. Think about that for a moment. The number of banks today is about 50% of the number of banks that we had prior to 2008. So, for that reason, I suggest to my clients that it's okay to ride on more than one horse. It's okay to do business with more than one bank, because you want to protect yourself in case your bank has problems, in case your bank fails. I had a couple clients whose bank failed during the recession, and that was a very difficult situation when their bank failed. And they had to deal with a new bank that they had never dealt with before, with new regulations, new requirements. So I think it's a good idea to deal with multiple banks, a little bit of competition, not a bad thing. Uh, number two, know that your cost of capital is going to be greater than what's going to be stated in what's called a term sheet. When you go to the bank to borrow money, if you've been approved, they're going to give you what's called a term sheet. And that term sheet is going to list all the terms in this loan, how much money you're borrowing, what the interest rate is, what's the term of the loan, collateral, and such. And just know if the interest rate, again, is say 7 or 8%, your costs will exceed that over time, because you'll be paying different fees. They may require certain reporting. You may have to provide accounting audits on your business. So just know that your costs overall are going to exceed whatever that stated interest rate is. Third do is you want to uh, raise more capital than what you might need in the immediate present. You may think, okay, today I need $50,000. Okay, but you're going to need maybe a little bit more money in a month, or 3 months, or 6 months. So I usually tell my clients is ask for more money than what you need today, whether you're borrowing money or you're looking for investment capital. I would rather you take in more money than you need and have a little bit extra just in case, than not take in enough money and have to turn back around in several months and ask the bank for more money. The bank doesn't want that. You don't want that. So raise a little bit more than what you think you need for the immediate time. Number three, number four, do is you want to be able to tell a good story when you're raising capital. There's got to be a good reason for why you need this money. It needs to be a compelling story. Again, whether it's a bank or an investor, a compelling story like, hey, we're growing rapidly and we need cash to help finance that growth. Or I need that piece of equipment, or I need to buy that piece of real estate, or I need to hire that top salesperson. There's got to be a good story, a compelling story for why you need this money. And you want to create that story before you have that first conversation with the banker or the investor. Tell a good story. The fifth do, know your market. Before you go looking for money, you need to do your own research, both whether it's banks or investors, and find out who's lending money, how much money are they lending, what banks are specializing in what types of businesses. I'll never forget one of the first times as a business owner, I went to borrow money. And at the time, my wife and I owned a travel agency. This was down in South Florida. And we'd been in business for a couple of years, steady growth, healthy growth, and we needed some growth capital, just some working capital. So I went to the bank, and I knew the banker. We used to meet once a quarter. I'd share financials, so the banker knew our situation. So when I went to borrow money for the first time, I waited for a week or so and I got a response. I had been turned down by the bank. They said no. I remember thinking, how could that be? How could this be possible? Well, I hadn't done my homework, because the banker that I was talking to had been in banking for over 20 years. Successful banker. In his career as a banker, he had only had one loan that had ever failed. One loan that didn't get paid back. What kind of business do you think that was? It was a travel agency. this lender, this banker was never going to loan me money for my business because he had had a bad experience previously in my industry. And in his mind, he had made up his mind that he was never going to lend money in my industry again. I had failed to do my homework on that bank and on that lender. So make sure that you know the market. Do your homework ahead of time. All right. Now we'll get to a couple of the don'ts. Maybe the most important don't. Don't take on too much risk. Remember, borrowing money is risky because when you borrow money, you have to pay it back. Investment capital, not as risky, but now you've got business partners and there's some risk inherent in taking on new business partners. So you want to weigh the risk between borrowing money and taking equity financing and know that, again, a good kind of mix is maybe for every dollar of investment, there's a dollar of debt. Also know, we talked about this a couple of weeks ago, for banks today, the maximum debt to equity ratio to qualify for a bank loan today is 4. For every dollar of equity, $4 of debt. If your debt to equity ratio exceeds 4, you're considered too risky for the bank and probably too risky for yourself. So be careful not to take on too much risk. The second don't is don't put all your apples in one basket, so to speak. Um, Good to have a mix of financing. You don't want to have 100% debt. You don't want to have 100% equity. Maybe, again, multiple banks. It's okay to kind of spread the wealth in terms of whether it's your borrowing or working with investors. The next don't. You don't want your bank loan to appear to be shopped. Let me explain. So while I certainly would recommend that when you're looking for capital for your business, that you want to be shopping. You want to talk to different banks, you want to talk to different investors. You want to shop for your money. But what you don't want is for that your loan to appear to be shopped to a banker, because bankers don't like to know that they're the third option or the fourth option or the fifth option. They want to think that, hey, you're the first bank that they've been to. And one way that you can prevent that is when you're talking to a banker, you do not want to submit a loan application until you're certain that you want to borrow from that bank. Because once you complete that loan application, it's going to hit your business credit and it's also going to hit your personal credit. It's going to show up. So now the next person, the next banker looking at both your business and personal credit, they're going to see that you applied for a bank loan 2 weeks ago, and they're going to wonder why didn't you get approved by that bank and why are you now at this bank? So while you do want to shop for money, you don't want your loan or investment to appear to be shopped. Okay? And the last don't is no surprises. No surprises. The banker or the investor is going to ask a lot of questions about you, about your business, your customers, your vendors. When they look at your financials, they're going to look at lots of different questions. They're going to ask a lot of questions. And you need to be, in some cases, painfully honest uh, with the bank, because they're going to find out on their own. They're going to do their research. And if there's been a bankruptcy, they're going to find out. If there's been a divorce, they're going to find out. If you have had an issue with a bank in the past, they're going to find out. So better that you tell them up front, be honest, rather than surprise them at the end. Because if they find one or two surprises, they're just going to assume there are 4 or 5 surprises. And the last thing a banker needs in approving a bank loan is a surprise from you as a potential lender. So no surprises. Okay. All right. So you've got a handful of do's and don'ts. I hope these are helpful. We've got a little bit of time left today, and I'd be happy to answer any questions that we might have. Danny, we can take down the workbook, and Pagine, do we have any questions?
Um,
I'll give you a little bit of time. If you've got a question, just put it in the chat, and I'll be happy to answer it for you. Pagine, do we have a question?
There's a comment in the session that um Morale wants to know if we have covered the materials before page 20.
We did. We had earlier, we had two sessions on the financials, and we also had a session on budgeting. So the material prior to what we covered today was on budgeting, financial planning, and we did have that program, what, maybe 2 months ago.
And we have a question from Chef. Chef, do you want to um speak up or leave your comments?
I'm sorry, was that a question?
Um, yes. So question from Chef, as a small business with a product in retail stores, do we have a good chance of getting capital?
That's a good question. Um, One, they're going to look at how long you've been in business. Did you just get your product into retail stores, or have you been doing this for 3 years or 5 years? They're going to look at the nature of the product. Is it something that is sold repetitively, time and time again, or is it kind of a one-time purchase? They're going to look to see if you've got orders for that product, and how much are the orders, and how long have you been getting those orders. Those would all be positive aspects for a bank. Um, but yeah, if you have a history of already having sales and revenue, and if the customer is maybe a national brand, that would also help. All those would play in your favor in getting financing, and being able to use the product. If you have inventory, you may be able to use that inventory as collateral for the loan. And I see you just launched in Walmart, and certainly that's a big, not that's an international brand, and certainly that should play in your favor, particularly again if you have already have written orders. Good question.
Um, Another questions from Morale. Um, Need some pointers on once we get the finance, how do we ensure safe investments into business in these changing times?
Hmm. So once you've gotten the loan, how do we make sure? If you would just read the second part of that for me.
Safe investments into business in these changing times.
Yeah. So, boy, have we ever had more uncertainty than we have today in business. And you know that, and I know that, and certainly bankers know that. So, again, bankers tend to be very conservative, just their personality, and they would like to see some level of conservative management in their clients. So in terms of your use of funds, they'd like to see that you're using that money not in a speculative way, something that could or could not go well, but something that is maybe less risky, like purchasing a piece of equipment or purchasing real estate, purchasing inventory, things that will not only help your business grow, but are helping you grow in a safe and consistent way. So they're going to be very mindful. They might not be able to control how you're spending your money, but they're going to be very mindful of how you're spending your money, particularly if you have to go back and borrow additional funds. So uh, you want to use the money in as less risky way as possible. Good question.
And I think Morale made a comments on his question saying that it's a EIDL SBA loan, not from banks. So the questions probably will be,
Yeah,
is
that's a little different because in that case, you're borrowing, if I'm reading this right, you're borrowing directly from the SBA through a disaster program, and their requirements don't tend to be as strict as what a bank would would have. So you just want to make sure that you fall into whatever their loan requirements are, and you don't want to violate any of the loan document. But typically, you've got a little more leeway with that than you would a traditional bank loan. Okay. Additional questions?
Yes. Another question from Omar. We are trying to buy a business. It's very hard to find a funding partner. Any recommendation on private investor or what other routes we can take?
Yeah. Well, I wish you great success with that acquisition. The SBA has a particular loan program. I forget which one it is, but one of the loan programs is geared towards acquisitions. So that would be the first thing I'd look at would be if that SBA program fits the acquisition that you're doing. I would also, not unusual at all when you buy a business, that you would ask the seller to provide you with some type of loan. And if you're able to do that, then the bank is going to be more likely to lend you money if you're also getting a loan from the seller, because that way they're sharing the risk on that loan with the seller of the business. So, not at all unusual to get what's called seller financing on an acquisition. It's also going to depend, like I said earlier, on the industry that you're in, how long you've been in business, the business that you're acquiring, what their financials look like. Are they a healthy company that you're purchasing, particularly when you merge the two companies together? Is that result in a healthy company? But so a number of factors that the bank is going to look at, and they know that not all acquisitions are successful. And so they want to make sure that they're investing in a successful merger of sort. Good question. Beijing, we had a couple questions earlier.
So we also have a questions about what are some warning signs in financial KPIs that a business might not be loan ready yet?
Yeah. Yeah, there are a number of things. And again, going back to those 5 C's I talked about, but in addition to that, they're going to take your financials and they're going to calculate a number of the ratios that we looked at a couple of weeks ago. And they're going to look at your profitability. They're going to look at how fast your business is growing. They're going to look to see not only if you're profitable, but are you producing positive net cash? Because remember, it's possible for a company to be profitable on the income statement, but not producing positive cash on the cash flow statement. So they're going to look to see how much cash your business is generating, and are you generating enough cash to pay what would be your monthly principal and interest payments. They're going to take a look at your financials, and particularly they look at the assets on your balance sheet to see, are there receivables that can't be collected? Is there inventory that can't be sold? Is there payables? How are you doing on your payables? How well are you paying your vendors? Are you paying your vendors on time? Those kind of things. So yeah, and one thing I hear, and it sounds kind of silly, but they're going to look for any mistakes in your financials. If they see a mistake like numbers that don't add up or a balance sheet that doesn't balance, and I've seen more than my share of those, when a banker sees one mistake in your financials, they assume there are multiple mistakes and they just haven't found them yet. And they get very suspicious. So make sure that there are no mistakes in your financials. Also, make sure in your financials, sometimes I'll look at a financial, whether it's an income statement or balance sheet, and one of the line items, say on an income statement or expenses, it'll say miscellaneous. Well, what's miscellaneous? And if I'm a banker, again, I get very suspicious. Is miscellaneous money that you're taking out of the business? Is it money that you're spending on a vacation, a boat, a second home? So I tell my clients, you're not allowed to have miscellaneous line items in your financials, because that's certainly a yellow flag for a banker. They get very nervous when they see miscellaneous on your financial statements. Okay.
And I think that's all the questions we have.
Okay.
Um,
One other thing that I'll mention, Paging, because I did mention this earlier, is if you're looking to acquire capital for your business, get help. Whether it's going to the SBA, they have counseling. The Small Business Development Centers, they're an arm of the SBA. They have consultants free of charge that can help you put together your loan package. They work very closely with banks. There are private individuals, brokers of sorts, that'll help you acquire capital if you're a business, whether it's a bank loan or equity. But talk to other business owners who have maybe recently gotten a bank loan. Ask them, who did they talk to and what did they experience? You don't have to do this alone. I would strongly suggest if you're looking to acquire capital, if you're a business, don't be afraid to ask for help. All right, so I hope that you found this helpful. My name again is Tim Fulton. My company is Small Business Matters. If you're interested, I publish a monthly newsletter. I also do a podcast, and you can find each of those on my website at smallbusinessmattersonline.com. I want to thank again USPAACC. I want to thank TD Bank for their sponsorship and wish all of you great success in your business. Thank you.